Hello, everyone, and welcome to today's Saving for College webinar. I'm Mark Sir with Saving for College. Very excited to have you all join us. It's going to be a really great program as we give everybody a moment to just kind of get settled and join our broadcast here. I do want to remind everyone that this session will be recorded and shared with you all later this afternoon once we're able to get it up to YouTube. So don't worry if you miss anything or have to drop off early, come late. We will be able to get that recording out to you. Definitely go ahead and share that with your friends and family. We're going to be talking about how to give gifts into 529 plans. That might be a section you want to flag for them as a little bit of a hint going into the holidays. But please do, share that with your friends and family. And we'd love to hear your feedback on the webinar afterward. I would like to take just a moment here to thank our presenting sponsor for making this free webinar possible for everyone. For over 20 years, the T. Rowe Price College Savings Plan has been helping families save for college and other qualified education expenses in a tax-advantaged way. This 529 plan offers a variety of professionally managed investment options designed to address different time horizons and investment strategies. The plan also offers online tools and insights from T. Rowe Price certified financial planners so that families can develop their college saving strategies and be more confident about providing for their children's higher education needs. T. Rowe Price was also really generous today to share Mr. Roger Young with us. He's a thought leadership director with T. Rowe Price and helps the firm develop its perspective on personal finance topics. Does a lot of research and writing around these college savings, financial aid, student loans issues. And he's also a father that put his kids through college using 529 plans, has gone through that whole process of opening a plan, contributing, and withdrawing. So we really love to have Roger here to share his perspective. He did an incredible job kind of in the prep, really tailoring today's program to fit the questions that you all shared with us in the registration. So thanks to the audience members that shared questions. And I do want to remind you that if you have any questions, please do go ahead and put them into the Q&A box. We'll try to kind of take those as appropriate as we kind of move through the program. And hopefully we'll have some time at the end to also go through those questions. So without further ado, Roger, let's go ahead and really jump into things. A lot of topics to cover here, so I want to make sure that we leave plenty of time for everything. And I love the way that we're starting, today's program where we're really getting right at the heart of why a lot of folks are here today, and that's to save money on their taxes while they're saving for college, which puts them, in a much better position when they go to make their withdrawals. So, Roger, this is a big question. There are a lot of parts to it. How do you kind of break this down about what are the tax benefits of saving with the 529 plan as opposed to one of the many other, instruments that might be out there as an investment?
Great. Well, thanks, Mark. Yeah, it's always good to join you on these. And yeah, you're absolutely right. This gets at the heart of it. 529 comes from, tax code, the number. So yeah, it's largely about the tax benefits. And the big tax benefit is on the federal income tax side. So when you put money into a 529 plan account, you don't get a tax break at that point, but then over time, the gains and earnings that you have on those investments are tax deferred. And if you use it properly, so to speak, in terms of taking money out only for qualified educational expenses, then even the gains are tax free. So if you're familiar with doing a Roth IRA or a Roth 401k, you could think about it as similar in that sense to a Roth. You don't get the benefit up front, but you get the benefit later when you're taking the money out. So that's on the federal side. And then on the state side, first thing I'll mention that sometimes we kind of gloss over is that in general, states also are not charging you, they're not making you incur taxes on money that you then take out of a 529 for qualified expenses. So that's important to come at right away. The additional potential benefit you get on the state side is a lot of states will then give you an actual tax deduction up to a certain point for money that you put into a 529 plan account. Now, in some states, that means it has to be in that state's plan, but there are a number of states, I think it's about 8 states, if I'm remembering correctly, Mark,
Yeah, I think we're
that
actually at
are,
9 even now.
are
So
now up to
it's
9. Okay,
fantastic for those folks. Yeah.
great. That allow you that benefit even if you're going with an out of state plan. So benefits both on the federal side and the state side. One interesting quirk that I noticed is, doing research for this, there is one quirk if you live in Alabama that, if you put money in a different state's plan in Alabama, those monies coming out actually don't count as qualified expenses. So you just need to be a little bit careful if you're in Alabama. But everywhere else, at least you're getting kind of the federal tax benefit and potentially a state plan benefit. Um, Maybe we'll talk a little bit about what are qualified expenses, and we'll probably go into this a bit more. But they're what you might expect: tuition, fees, room and board is included, which is not necessarily something that counts for other tax benefits. So it's a nice complete list, and there's a lot more to it, but the big ones are included as qualified. In addition to now with some more recent regulation, to a certain extent, money that you spend on K through 12 tuition, as well as to up to a limited extent, money that you use to pay for repayment of student loans. So a lot of things that we can dive in more later if you want.
Yeah, yeah, we'll definitely go into the qualified expenses in just a moment here. Roger, I really like the way that you had kind of set this up there, starting on the federal side, because I think a lot of folks initially think about the state tax deductions that are available when they think of 529 plans. But the three largest population states in this country, California, Florida, and Texas, either don't have a state income tax at all, or they don't have a state tax benefit for the 529 plan contribution. But on the federal side, that's really where you're going to see the bigger impact, I think, for most folks. And that is available to everybody, who's in the United States. So I think that that's a really important point. And also, so a lot of folks don't itemize their deductions, right? In which case they're not going to be able to get the itemized deduction for the state taxes. Maybe they're lower income. Now you've got a very high standard deduction. So there are more people just taking the standard deduction. You still get the federal tax benefits there. So I think that's, really important, is that for a really wide, number of people, 529 plan makes a lot of sense. Now, there was a question here from an attendee, Roger. I don't know if you have a view on this. The first thing I can think of is kind of the state tax deduction existing. Is how do the savings in the 529 plan compare to like a custodial IRA in terms of tax benefits? It sounds like it'll be pretty similar on the federal side, but you're not going to have, the state tax breaks that are available for 529 deductions.
Well, I'm thinking, custodial IRA is a bit different, but like a custodial account, like an UTMA or UGMA, Uniform Transfer to Minors Act account, where you put money in, for a student, into a minor's account. Um, it's interesting. There's to some extent, with one of those accounts, the student, the minor would count the returns on their tax at their tax rate, which is often kind of low. But then above a certain level, it's at the parent's rate. So I would say the tax benefits are generally a lot better for a 529 plan than one of those custodial accounts for a minor. Um, and I'm trying to think if there are other aspects relative to an IRA. You sometimes hear people ask, well, what about using a Roth IRA that I'm using for retirement, but potentially use that money to pay for college? And the caution I'd have for you there is, yes, you can take out some Roth money and some of that be penalty free, but you also have the issue of, if you're looking for financial aid, money that you take out of any type of IRA, when the student's in college, that gets added to income and it counts against you for financial aid. So I like for people to kind of keep things clean in terms of, if you think the money is going to be used for college, the 529 is a great place to go. And again, like you said, I've used them successfully myself. Whereas, a Roth is for retirement, and I think it's better to hold on to that money for retirement.
Excellent. I think that should hopefully answer that question pretty effectively for that user. So thanks for that, Roger.
Mhm.
So now that we are able to save a little bit more because we're not paying taxes on our earnings,
Mhm.
how do we think about setting up a goal, right? Is it as simple as plugging into a calculator and seeing what the projected tuition and fees and room and board at an expensive school is going to be in 18 years? How do we kind of think about this, from a family perspective where we have all kinds of competing financial interests? We're trying to save for our own retirement, right?
Mhm.
How do you think about this, Roger,
Yeah.
for
Yeah, I think very good question, and certainly those calculators can be very helpful. And we, with our plans, we have calculators that we provide to folks. But in terms of a realistic goal, if you look at what people actually do spend on college and how they pay for it, on average, roughly half of the money comes from the parents' savings and earnings during college. So we have often said aiming for getting to that half is a good goal. And then in order to do that, then you can do some math on, okay, well, what do I need to get up to, saved, having half of it saved up, during, the college years. You can use a calculator to help with that. We toss out a number in one, piece of content that is, if you're thinking about public college, with the state benefit, in-state tuition, and you are thinking about room and board, if you were to save from the time of birth up through college, $260 per month, that might get you there. Okay. But I have to, put in a lot of caveats there that that's just for that specific, circumstance. And your situation might be different in terms of, whether, you want to think about possibly a private school, or you do or you don't want the to allow for the room and board, living on campus. Maybe you want to budget less because you're thinking of a couple of years of community college. So there's a really wide gamut. So don't want to paint a picture that there's a right number that we can tell for everyone, but it's not a number that necessarily is easy to get to. um, some people also might want to aim for higher than that 50% of the college bill, partly because they might be trying to completely avoid loans. And that's a great goal if you can do it. Or they might say, some people get money for college from grants and scholarships. And, given our situation, that doesn't seem as likely. So you might want to aim higher than the 50% or lower if you think, you'll qualify for a lot of aid. So I'd say, that number I tossed out is one thing to consider, but yeah, you want to do your own math on, what gets me to a place where, college is going to be feasible for my student.
Excellent, Roger. Yeah, there's so many variables, right? So I think it's all about kind of doing the work with some of these calculators and seeing what might make sense for your family, what your goal is, I think is really important there. So I think hopefully that gives folks kind of the good starting point of how to think about this question.
Mhm.
I gotta give a lot of credit to our audience here. They are front running me a little bit here with these questions. So the last question we got here in the Q&A, and folks, we're going to cover a lot of the other questions here, so just stand by with me. But one of the most recent questions we got was, how will 529 savings affect the student aid index for financial aid when we submit the FAFSA? And so, Roger, I'm going to turn this one right over to you because this is, I think, one of the more difficult questions to answer in a good way for people because they don't want to put themselves in a position where they're not going to have financial aid down the road, and they get very concerned about how their savings are going to impact their financial aid. But I think they should be a little bit less concerned about that. What do you think here?
So the way I characterize it is, those assets do affect financial aid. But when you look at the student aid index calculation, it is overwhelmingly driven by the income of the parents. And then if the student has a lot of income or a lot of assets, that weighs pretty heavily. But assets that are owned by the parent are not treated as badly for the financial aid calculations. So I think the percentage is about 5.64% of the assets are counted toward that student aid index every year. And the thing I'll also point out is that if you're thinking about, well, do I save in a 529 or elsewhere? Well, if you have those assets in some sort of investment that's not in a retirement plan, they count the same, basically, the 529 or just, a taxable account or a brokerage account or something like that, or even a bank account. They count the same. So I wouldn't say that that's a reason to choose something other than a 529, instead of a 529. Um, and I mentioned earlier the thought of, well, hey, well, what if I put it in a retirement account? That's not counted as an asset. It's not counted as an asset, but when you pull it out, it's counted as income. So that's actually even worse. So I would say it's important to consider. And in a number of the questions you get, kind of the undercurrent of it is, well, should I be careful not to put too much into a 529 plan account? And I think the short answer is yes, you want to be careful not to put in too much that you're not going to use. But the flip side of that is probably more important. You don't want to be someone who is a relatively high income person, compared to the population, and have undersaved, because the financial aid calculation doesn't give you a whole lot of break in that situation. You don't want to undersave, just for the purpose of getting financial aid, because that might backfire on you.
I think that's a great answer, Roger. I really appreciate that. So I do have a follow-up here, and I think you did cover this one pretty clearly. So the savings, there was the question about the custodial IRA a moment ago.
Okay.
And would that count as assets for the SAI? It sounds like what you're saying is it would not be considered under the assets, but once you go and make those withdrawals and give it to the student, that becomes the student's income. And so that would get assessed at a higher level for the SAI. Is
Yeah.
that right?
Well, I'll say I know for sure that excuse me, a 401k or an IRA, owned by the parent, is treated like I was just describing. It's excluded as an asset, but if you take that money out for purposes of college or whatever, that is a negative effect, in terms of counting as income. There are also some slightly different rules for self-employed people, so I just want to put that out there, that you want to be a little bit careful. But for most people who are employees of companies, putting money into a 401k, that money doesn't add to your income when you put it in. It doesn't count as an asset. When the term custodial IRA, then I'm thinking, someone might be thinking of an IRA for a student, funded with money that student earned, as a teenager, perhaps. I'm not exactly sure how that counts in the FAFSA. I don't want to misspeak
Under-
on that. So yeah, would want to,
Understood. We'll stick
I'm
to
going to punt on
529s
that one.
today.
Sorry.
I appreciate it, Roger. I do want to mention one other thing here as it relates to financial aid. We're going to talk a little bit more about like grandparent-owned accounts and other loved ones and how they can get involved. But with the new FAFSA, with the simplified FAFSA, we actually have the opportunity now to have grandparent-owned 529 plans, other loved one, owned 529 plans not be considered student income when those withdrawals happen. And that's a really significant change that used to be a big complication around financial aid when you had other loved ones saving, other financial support. So now no third-party financial support coming from grandparents, aunts, uncles, other friends, etc., is going to impact your SAI. So I think that that's an important point, and I see some questions and notes about it here in the Q&A.
Yeah,
So hopefully that clears that up and makes people feel very confident about opening a 529 plan as a grandparent now.
yeah, I think that's a great point.
So we've kind of established some of the good benefits here of 529 plans and how much we need to save, how it's not such a big deal as it relates to the financial aid. We've got a bunch of questions here that kind of speak into this section of the slide here. How to choose the 529 plan. And so the first question here was actually, can I open 529 plans in multiple states? And that is absolutely a possibility. One of the most common misconceptions is that you have to open a 529 plan in your own state, or you have to go to school in the state which is sponsoring the 529 plan. And these are not actual restrictions. So that's something that you should feel, free to move about the country in terms of your 529 plan selection.
Yep.
Roger, there are a number of questions here on maximum contribution limits, which I think is really interesting, both like from the yearly perspective, and then I guess also
Mhm.
from max. Can you kind of describe to folks like at what point does there start to become some kind of a restriction around contributing to a 529 plan?
Yeah. So there are a couple types of restrictions that apply, and one is kind of the practical restriction of the annual gift tax exemption. So if you're thinking about a 529 is treated essentially as a gift from the parent to the student. When you put money into a 529 for that student, it's essentially a gift. And if you stay under that annual exemption, which is currently, I believe, $18,000 per year, and it gets adjusted every year for inflation, then you have no issue with gift taxes. You don't need to file a gift tax return. It doesn't count against your lifetime estate tax or gift maximum the exemption. And I think for the vast majority of people, that 18,000 is not a particularly tight restriction. If you can put in more than that per year, great. And if you're married, you each get that 18,000. So as a couple, you could put in $36,000 per child, and you think about that over 18, 20 years of a childhood, and that pays for a whole lot of college at a pretty nice place. There's also this concept of kind of super funding or front loading, where you can put in essentially 5 years of that $18,000 at one time up front. So people who are really concerned with minimizing their eventual estate tax, if they're in that position, will sometimes use that super funding, and they do it one time, then you can't use it for the next 4 years. So it's a one time in 5 years using 5 times that exemption, and that's a kind of a unique thing to 529 plans. There's also, each state will have some sort of limit on how much you can accumulate in a plan. It might be stated as a limit on the contributions, or it might be on the balance. But those tend to be what, 300,000, 400,000. I haven't looked at the details lately, but again, I don't view those as a particularly tight limit for most people. Mark, you might have some more up to the date information on that, but yeah,
Yeah,
those
there
lifetime
are a
maximums.
number of states that you could have balances over 500,000. So that should be enough to cover, 4 years undergrad, maybe even some grad school. Um, so yeah, there aren't too strict limitations on how much you can contribute. So hopefully folks feel that that works for them.
Yeah.
I want to cover really quickly because we have an audience question about prepaid plans, just kind of the
Hmm.
difference between a prepaid plan and a savings plan. Roger, if you would just briefly kind of describe the specific question was, we live in Florida and they have the Florida prepaid plan, very popular in my home state. What's the difference between this and the 529 plan? And so the prepaid is a type of 529 plan, right? But it's a little bit different than what we're describing here.
Sure, I'm glad that came up, because as you were talking about, the kind of, does it make sense? Can I go out of state for my plan? I was thinking, well, the prepaid plan is a little bit of a different situation, in that a prepaid plan typically is going to say, okay, you're funding a certain number of years, or a certain portion of tuition, in today's dollars, that then will apply to that number of years of tuition in the future, regardless of how much inflation there is in that tuition. So you're protecting yourself against a lot of inflation of the cost of college. And with those plans, there generally is a significant advantage to staying in state. Okay, so I have a good friend who lives in Virginia, and did the prepaid plan with the state of Virginia, and it looked really good. One of his kids went out of state. One of his kids was in state, and there definitely was a pretty big advantage for staying in state in that plan. So I think that's worth noting. I would say it feels like the prepaid plans are maybe less in favor than they used to be. The administration of some of those plans hasn't been great. I live in Maryland, and actually, thankfully, my firm was not involved with this, but there were some hiccups in the administration of the prepaid plan in Maryland. So, I am an advocate of doing a 529 college savings plan where it's based on investments, and part of the thought process there is the goal of those investments is to have returns that are greater than inflation. So therefore it helps you more than just kind of locking in the tuition that you get with a prepaid plan. So that's my personal view.
Thanks for that, Roger. And it leads us kind of into the next question I want to ask you about around the investment options, right?
Mhm.
So in these savings or investment plans, what are the kinds of investment options that are available? Am I able to buy gold bars? Am I able to, get individual stocks? Maybe you could kind of describe how the menu is structured a little bit.
Sure. I mean, the menu has some limitations to it, certainly. And typically a state will contract with a particular investment company like mine, T. Rowe Price, and the offerings will often have some combination of target enrollment date funds that are geared toward having a more aggressive investment early in a child's life, and then it gets more conservative as the college enrollment date approaches, so that you're kind of reducing the risk of something bad happening right around when a student goes to college, and not having the money that you thought you would have. So that enrollment date, I think is a great option. I've taken advantage of that. Typically there are other options if you want to just put money into a stock fund, or just into a bond fund, or even a money market fund. Those are commonly offered as well, and you can often do combinations of those. One of the things I like about the enrollment date fund is that it's making those adjustments over time for you. There is a limitation of you only get two investment changes, investment strategy changes per year, where say I want to move money from an enrollment fund into all equities for some reason. Well, you can do that, but you can only do that twice a year. Whereas if you're putting the money into an enrollment fund, you don't have to use those somewhat scarce opportunities to adjust your mix down over time. It does that for you. So I think there's a lot to be said for the enrollment date option.
Excellent. Thank you for that, Roger. So now we'll kind of skip ahead a little bit in our savings journey to the point where we're actually ready to make withdrawals. So you'd already kind of touched on the idea that 529s are not just for tuition. There are a lot of expenses like room and board and fees, even computers and supplies now. Um, but I think the question is, how do I pay for some of those things with the 529 plan, right? A lot of the
Mhm.
schools have the opportunity to just have the tuition paid directly from the 529 plan. That
Mhm.
makes it very easy. But if
Yeah.
I'm living off campus, if
Mhm.
am shopping at the grocery store for my food, it's a qualified expense. But how do I make withdrawals from my account? How do I keep track of this to make
Yeah.
sure I'm not having a problem?
Yeah, and this is a not a trivial question. The logistics do matter here, and yes, you can have the money go directly to the college for tuition. You can have it go to you as the account owner, and um and honestly, that's what I did. I would pay for expenses out of my own checking account, and then have the 529 account reimburse me for those, or take it out up to a limit. You mentioned the issue of, well, room and board for someone off campus. Every college every year will publish what they have calculated as the cost of attendance of that college, and that will include an allowance for off-campus room and board. So as long as you stay, under that amount in terms of what you take out, it still counts as a qualified expense. I will tell you from personal experience that, where my youngest went to college, it cost a lot more for his his rent than the college thought it would in terms of their allowance there. So you do have to be a little careful. There, it might not cover 100% of what you think of as the expenses for some of those things. The other thing I will mention is timing wise, you do need to match up, when the money comes out of the 529 plan account and when it actually gets incurred. So, if your college is on a cycle where, they actually bill you in January, you want to make sure that, the money you're taking out relative to that January bill is in the new year. It's not, you're taking the money out in December and then getting the bill in January. So you do want to be careful with that. And it has been, historically for me on my tax return, one of the more complicated parts of filling out my tax return to make sure I don't make a mistake on, um, you know, putting in information that I get from the college and from the 529 plan and my own records on what we've incurred. So it's not trivial,
Excellent. Well,
but it's
hopefully
worth
that,
it.
yeah,
As
and hopefully that
the
gets
other point.
people prepared, right? It's
Yeah.
important to go into it with an organized, plan around your withdrawals. It's not
Yes.
something you just can do. So
Yep.
I appreciate that, Roger.
Hmm.
Um, Move to a very similar question here, right?
Hmm.
But what if the child gets a scholarship, they're admitted to a service academy, they don't go to college at all? We've gotten
Hmm.
a lot of questions in the Q&A and in the registration around changing beneficiaries. And I think there's a lot of flexibility here. So maybe you could kind of break down some of these
Hmm.
different situations that could occur.
Yes. So yeah, this comes back to that question of, well, being careful not to overfund a 529. And I think that's a valid point that you do want to you'd rather not overfund it. But if you do for one of these reasons, there are some protections. So for example, with the scholarship or service academy question, you can take out from the 529, an amount up to that scholarship or the value of that service academy scholarship, and you won't pay any penalty on that. Now you will pay tax on the returns that you've gotten in the 529 account, but that just kind of puts you on even footing with if you had done it, in a brokerage account, an outside account that you're paying taxes on those earnings. So, that's one option. Another option is, you can hold on to that money for, potentially, grad school later, or for, a sibling or another relative, or even yourself. So yes, the short answer to the second question is yes, you can change the beneficiary to a family member. I think we got a question, sent to us in advance. Well, what about step siblings? Do those count as family members? And the answer is yes. So there's a fairly loose definition of family for that purpose. So yes, if you have multiple kids, that helps kind of take the pressure off in terms of, if I'm trying to aim for that 50% number that we talked about through a 529, and one of the three kids doesn't go to college or gets, doesn't have to pay much for college, well then, you might be able to use that money for the other kids. So that hopefully is helpful to you in, putting your mind at ease that there are other options. And then, there are non-traditional type of college expenses. We mentioned, community college and, even some continuing education programs as an adult, or, grad school, or even some trade schools. So there are a number of ways to have qualified expenses beyond, the traditional four-year college.
Yeah, exactly. And now we even have a great opportunity out there with Secure 2.0 for folks who do have leftover funds to
Mhm.
roll money from their 529 plan to their Roth IRA. There are some limitations and restrictions here that folks need to be aware of. So the first few here are that the beneficiary of the 529 plan and the Roth IRA need to be the same person.
Okay.
The 529 plan has had to have been opened for at least 15 years. It is currently an open question as to whether if you roll into a new 529 plan, that resets that 15-year clock. We're hoping for IRS guidance on that and some other things, as my little asterisk here indicates. And then of course you've got the total amount transferred can't exceed $35,000 a lifetime. So it's not that you'll be able to, pull all money over into the Roth IRA. And you do have the annual funding limit there that will still apply. Now, interestingly, the income limitation will not apply for this provision. You will still need to likely have earned income. Again, somewhat of an open question there. And we're hoping for some IRS guidance. And then the last clear restriction is that the amount being transferred had to have been contributed at least 5 years prior.
Yeah.
So that's Roger. I'll open it to you in case there are any things you want to kind of add there. I don't have much more at this point until we get that IRS guidance,
Mhm.
but I know that the plans have done a really good job trying to prepare for this and have a lot of information. And there are, state specific concerns as well. So it might be a good idea to just kind of reach out to your plan and learn about how they're handling this.
Yeah, I think you did a great job of summarizing it here and mentioning, some of these caveats. But again, it's just another way that, the Congress is looking out for people to give them a little help and say, yeah, if you put a little bit too much in a 529, there's this additional way that you can, take that money and not be penalized and have it go to a good purpose at the end. $35,000 is, for some people that's very significant. For some people, it's like, oh, that's not a big compared to what I'm putting into this plan over time. But it's a nice way of, hey, if you've got a little leftover money and you've been saving for a long time, you can help start setting up your student for retirement once they've gotten past college, and you were thankful enough to have a little extra money in the 529.
Yeah, and I really hope that it gives people some confidence to open a 529 plan to not have to worry, that they're going to have $15,000 left over in their 529 plan that they're going to need to take a penalty on.
Yeah.
So that's not going to be the case in this instance now. So I think it's a great provision. I just want to check through here, make sure there are no other questions related to this. Okay. There are a bunch of questions from grandparents. We did talk a little bit about the financial aid consideration. This is the part you folks are going to want to kind of bookmark to share with your friends and family about how to give gifts into 529 plans. And this is a big question, right? Because you've got a lot of cool platforms out there now to give gift contributions. Grandparents are able to open their own 529 plans. There was a question actually from a grandparent a moment ago. um, there are a few questions from grandparents, sorry. So the first one is, do we need to set up a 529 plan for each child?
Mhm.
You
Okay.
don't need to.
Yeah.
You can. That's,
Mhm.
100% up to you. And then as a grandparent, if we open in our name versus the parents, can other people contribute to the fund? So that kind of gets right at this question here. So
Yep.
Roger, I'll turn it over to you to get people to give gifts into the 529
Sure.
plans.
I mean, this is an area that has improved pretty dramatically from when I started, putting money into 529s, 20 plus years ago. And so, yes, not only is it better in terms of the financial aid aspect for grandparents to open their own plan and have control over that money, um, but yes, it's easier to give gifts as well. So really, as a grandparent, um, you can kind of think about what makes sense for your goals, and do you live in a state where making this contribution helps you on your state taxes? You can think about, is it just easier to give the money to the parents and have them put it in? That's what my parents did for me, because some of these options weren't available. So thankful to mom and dad for that. But yes, there are now these gift portals also if you don't want to open up a plan and you just want to be able to make it easy to make a contribution to one that's set up by the parents, I'd say a lot of plans now, a lot of states have these portals, and generally the way it works is the parents send you a link and like a code to use with it's associated with the child beneficiary. That way they're not telling you the account number. They don't need to put that in an email or a text message, but they can send you that link and a code, and it's very easy to go in and make that without the security issue of sharing an account number to a financial account with someone. So I'd say that's a lot easier than it used to be. And I would say from the perspective of the plans that we have it with that we help manage at Zero Price, that gifting portal has improved, and even in the last few years since we started offering one.
Excellent, excellent. Yeah, so folks, do encourage your loved ones to contribute to the 529 plans here. Holidays coming up, birthdays. It's really it's a great gift, that you could give and that you could get, and it's going to make a bigger impact, on the children longer term. I just want to take a quick question here from Massimo. About studying abroad and institutions abroad. So when we talk about like just study abroad at like an American university study abroad program, that is usually billed through the university and then is a qualified expense. But also
Mhm.
there are a number of foreign institutions, like actual universities abroad, which do accept United States financial aid. And that's kind of the key consideration. At any institution that accepts financial aid, you would be able to use your 529 plans as well. And so we have an eligible institutions finder on our site. The kind of tip though that I have to give people is you search for FC under the state code, that's foreign country. And it'll show you a whole list of all of the universities abroad that are kind of listed in the federal financial aid codes.
Good. Thanks for taking that one. That's good.
There's an interesting question here about the gift contribution limits, Roger.
Hmm.
And
Okay.
and so the answer there, I guess, is just that it's a gift in the legal sense,
Hmm.
just that we
Yeah.
described, right, for any 529 plan contribution. So in that case, you would be able to go up to $18,000 without getting into your lifetime gift tax exemption.
Yep.
So if you want to go that high, you are very generous, and that's a great gift.
Yeah, and I guess that there was also the question about, well, do I open one account for all the kids combined, or more than one? Well, if you're thinking you might be bumping up against that $18,000 per year limit, certainly open one for each child. And I think there are other advantages to opening one per child. For one thing, the target enrollment date is probably different, so the investment should look a little bit different, and it also helps you to kind of make sure that you're treating your kids evenly if that's important to you. So yeah, a lot of good reasons to open up more than one. I did have someone in the financial planning world who just said, just open up one and then split it up later. I don't know. I don't find it particularly onerous to have more than one account. That's just my take. And Patricia, who was on one of these with us a few times ago, was very adamant about open up one per child. So we'll make sure we represent that view here.
Excellent, excellent. I just want to clarify a quick question here for Sarah, asking, can you open the 529 plan in the state where you want your child to go to college, even if you don't live there? So they're thinking Massachusetts for school, they live in Florida. So as a Floridian, you can open any 529 plan. There's no state tax advantage because we don't pay state
Mhm.
income taxes.
Mhm.
And you're able to use your savings programs, right, at other schools. Just maybe consider to look at the savings programs as opposed to the Florida prepaid if you want your child to go to an out-of-state school, as Roger was kind of describing earlier.
Yeah, and you can also think about if the grandparents are in a different state like Florida that doesn't have an income tax, that might be a situation where if they're comfortable with it, give the money to the parents, let the parents put the money in, get the potential benefit in their own state. Again, that's lots of different permutations of it, and the control factor of who controls the account might be important to you as well, in addition to the tax benefits. So, but yeah, the good thing is you're not penalized for having a grandparent account anymore.
Awesome. So this question has come up a couple of times in the Q&A. It was definitely asked a number of times in registration. Um,
Mm-hmm.
older children, if I've got my child in high school, there was somebody here in the Q&A, first year or second year of college already.
Mm-hmm.
Um, is there any possible advantage to using a 529 plan at that point?
Yeah, it's interesting. My answer to this has actually changed a little bit over the years because of the interest rate environment. And so, several years ago, I would have said, okay, yeah, there's still some benefit of a 529 plan, but the big benefit is that you get the tax-free growth of the investments. And back when, we were earning virtually nothing on, savings accounts and short-term bonds, if you're putting money in as parent of a 16-year-old, you're going to invest that fairly conservatively, right? That you don't want to be super risky a few years before college. And so the income that you get from a conservative investment was pretty low, so therefore the tax benefit was not that great. So I would say, yeah, there's benefit of having it earmarked, having it set aside for college, but not as much tax benefit. Now, that has changed because now you can earn, 3, 4, 5% on relatively conservative investments. And in addition, some of that money would be, interest income, and therefore treated, if you had it in a different type of account, it would be treated as ordinary income on your tax return. So there is more of a tax benefit for, older children and more conservative, accounts that go with them. So I'd say yes, definitely you haven't missed out on all the benefits. It's great to get started and have some of that money available, even if it's not going to cover a huge, chunk of the ultimate cost. I would strongly consider opening up a plan.
Excellent. Thanks for that, Roger. Yeah, and you've also maybe got some more time than you think, right? If your student's going to be in school for 4 years, there might be an opportunity, to continue contributing and maybe have
Mhm.
something available for that junior, senior year, or even grad school right afterwards. So, there are some things to think about there also for older children.
Yep.
Roger, we've got a bunch of questions here, and I didn't really foresee this, so I didn't do a lot of brushing up on this ahead of time, and I'm by no means an expert on UTMA or UGMA accounts.
Hmm.
There are a lot of questions on them here, and especially
Okay.
as it relates to like rolling them into a 529 plan.
Ooh,
Um,
okay.
any thoughts or tips that just kind of spring to mind that you would want to add? It looks like our audience has been really helpful in kind of answering some of these questions themselves
Okay.
for their peers, so we really appreciate that. But anything that
Yeah.
you would mention about UTMAs?
Yeah. I mean, I think the big drawback with those types of accounts is if there's a financial aid consideration, that accounts that are considered assets of the student get penalized more in the calculation of the student aid index. So that number, I believe, is 20% of student assets are counted toward the SIAI, as opposed to the maximum of 5.64% for parental assets. And yeah, I'm not an expert on the rolling over aspect, but if it's still considered an asset of the student, you want to be careful with that if you're looking to get some financial aid. The other thing I'll mention, more generally about UGMAs and UTMAs is the control aspect, and that came up earlier, when I was talking about with grandparents. But with a 529, you control as the parent, how that money is doled out. It is still it's for the benefit of the beneficiary, but if you want it to only be for college, you can enforce that. Whereas with an UTMA or UGMA, that money, you are, the custodian for it, But once that child reaches adulthood, which is in most states considered 18, they can take it. It's their money. They can do what they want with it. So you have less control. And if they want to take it and, take a 2 year trip across the country, they can do that. So kind of depends on, how much freedom you want your child to have, and whether you want to be able to enforce, using the money as intended for college.
Yeah, that's a really important point, I think, is the control of it all, right? Just to clarify, a quick question here from one, are contributions tax deductible? So at the federal level, 529 plan contributions are not deductible. There are over 30 states which offer state income tax deductions for 529 contributions. So hopefully that
Yeah.
clarifies that for you.
And those are
Um,
generally limited. Like, in the state of Maryland, I think it's $2,500 per year per beneficiary. So it's a nice benefit, but it's not like, you can put in $18,000 and get, an $18,000 write-off in my state. I would assume most states have, relatively tight limits on that. They want to encourage it, but not make it just a strict giveaway for wealthy people.
Excellent. And so this is the last question that we have here a slide for, but it is one that I think we can break down a little bit. So folks, if you've got more questions, and we'll go back through the Q&A box here, but we do have a little bit of time, I think. But the last question we've got here is, we're going into the end of the year. A lot of us are thinking about our finances, getting them right for the new year. I'm selling all the stocks that have been losing for me for the last few months for that tax, those tax write-offs. What should the 529 plan account owner be thinking about here as they approach the end of the year, when they're kind of reviewing their finances?
Okay. So I would say two big things. One is, if you're in the contribution phase, and you potentially can get a state benefit like we're talking about for contributions, make sure you take advantage of that during the calendar year. Okay, so that's a pretty straightforward one. It's kind of like, thinking about, contributing to a deductible IRA. Now, some states will allow you until the April 15th deadline, but some states do not. So you'll want to know what the rules are for your state, when the deadline is that you have to get that contribution in to get the state deduction in that tax year. So that's on the contribution side. The second is, like I mentioned earlier, on the withdrawal or distribution side. So again, if you want to match up the expenses that you have, when they were incurred for the student with what you're taking out. And, you don't have to take it all out, relative to the, what you can take out, but you don't want to take out more, because then you potentially could pay some taxes and even penalties on that money if you take out too much during a calendar year. And again, you might want to pace yourself in terms of, leaving a little bit for future years, if that's helpful for your kind of budgeting and mental math. But you don't want to take out too much, would be the main point there.
Excellent. Yeah, appreciate that, Roger. So that's kind of the end of our, prepared remarks, if you will, and Q&A. We do
Mhm.
have a couple more questions that we haven't fully covered, and go ahead and add to the Q&A, folks, if there are any topics that you'd like us to cover.
Mhm.
Yeah, we didn't get into this too much, but I do think it's maybe worth noting around withdrawals and such as the American Opportunity Tax Credit and how that
Mhm.
comes into play. So the question here was, who files for it? Is it the parent or the student? And
Mhm.
I don't exactly know the answer.
I,
It's the
I would
parent,
say
generally.
I would say generally that's going to be the parent, and I guess it's a good point to bring up. I'm not going to be able to do justice to all of the nuances of those, but if when I look at my TurboTax, uh, sorry, I'm mentioning a particular brand of tax software. When I look at my tax software, um, and it shows you how you may or may not qualify for different tax breaks on education. There are different things that qualify for, different types of expenses that do qualify for a 529 qualified expense, but might not for those other tax breaks. The other kind of overriding principle is you can't double dip, right? If you're taking money out from your 529, you can't also use those same expenses to get these other tax credits or deductions. That's kind of the overriding principle. So you do want to be careful if you might qualify for some of those other tax breaks to maybe leave some of the money to qualify for those as well. Hopefully that answers it well enough. I don't want to give tax advice or go too deeply into those calculations. But as I said, it is a little bit more confusing than a typical tax return for people today, especially people who aren't itemizing.
Yeah, and a similar tax-related question here, Roger, and this is one you should be, I think, fairly familiar with at this point. Do 529 plans send out any kind of a tax statement at the
Yes,
end of the year? And can you maybe
yes,
explain how that process works and what folks need to be aware of?
yeah. So they'll give you a tax form indicating how much you took out. So that's helpful. And I'm trying to think. I mean, at least on your statement, you'll get a summary of how much you put in during the year. So yes, you'll have the information that you need, and then separately, the college will send you a form indicating how much you put into how much you paid for tuition. Interestingly, colleges interpret that form a little differently. Again, I had 3 kids, and I had to be very careful of how I interpreted, what I got from the colleges. So a little bit tricky. But again, I don't want to, say all of this to discourage you. It was worth it, definitely for me, to put the money in the 529 and have to spend, an hour or two every tax season to sort it all out. Definitely worth that. And if you aren't comfortable with doing some of that yourself, you can, of course, pay a tax preparer to help you with it. That's always a good idea if you're not very tax savvy.
Yeah,
One other
that's
one other thing,
advised.
Mark, that came up in questions ahead of time that I did want to cover was, you sometimes get the question of, hey, if for low and moderate income people, do these make any sense, right? You know, um, in terms of they may not get as much tax benefit. And certainly, the tax benefit's going to be greater if you're in a higher tax bracket. But even if you're relatively lower and you're not paying, maybe you aren't paying taxes on capital gains, like I mentioned earlier, the piece that is ordinary income from interest, even at a relatively low rate, you can save some tax money on that as a lower moderate income person. And a big thing I want to mention is some states, like my state, Maryland, you can potentially even get, a state grant to help you when you first sign up for a 529 plan. So those I think are becoming more common, and to look at what the benefits are if you qualify, as a relatively lower income person, because a lot of states they want to encourage you to put this money aside. The stats show if you have money put aside for college, it makes it a whole lot more likely that student is going to end up going to college, even if you kind of control for income level. So it's a big benefit that even lower income people should consider.
Yeah, that's a really great point, Roger, and it's something we actually often fail to mention on this webinar because it's by state, right? Every state's going to offer something a little bit different, but you're
Mm-hmm.
starting to see a lot of matching programs, grant programs, for folks of a certain income level that would really, help out, I think, and make the 529 plan so much more attractive when you're able to get some kind of a match. So I
Yeah.
really appreciate you adding that.
Mm-hmm.
Um, any final thoughts, Roger, on things that had kind of come up in the registration? I'll just do two quick little summaries here because we just got some clarifying questions around some of the basics, right?
Mhm.
Given the rising costs of higher education, what's a realistic savings goal for a 529 plan? So Roger was explaining how typically you see about half of the college expenses will actually be covered through cash flow, student loans, and other financial aid, right? And so 50% might be a reasonable goal for a lot of folks.
Mhm.
And then the question, like, so what's the main tax benefit of 529 accounts? And there it's really the federal tax-free growth and the potential of the state income tax deduction. So I really hope, with that, everybody's feeling pretty confident to open a 529 plan, be able to use it effectively. Roger, thank you so much for joining us again. It's really always a pleasure to speak with you about this, and I think that the audience is really grateful for your time as well on a busy day.
Thanks, Mark. Yeah, time always flies by, and yes, hopefully we got people comfortable with being better informed than when they came in, and yeah, looking forward to the feedback and hopefully doing another one of these another day.
Yeah, and thanks again to the T. Rowe Price College Savings Plan for sponsoring this webinar. Folks, please do remember we're going to be sending out that recording, so share with your friends, and we'd love to hear your feedback on what you thought of today's show. So go start saving and have a wonderful day.